We're here to speak about LP directs. As we all know, funds may have started investing as LPs, but over time they've become more comfortable investing in the country directly and have thus built a deeper engagement in specific sectors. And this also brings us to questions like what sectors that LPs are more interested in for their direct portfolio. And also in the context of the pandemic that we're just coming out of, what areas look more interesting? To discuss this, we have two panelists. Neha, if I can start with you, can you take us through your LP strategy, LP and direct, and how that has shaped your direct portfolio?
Sure. Thank you, Ranjini. Pleasure to be here. Hi, Arjun. I think for us, IFC as an institution has been investing in India for over 50 years now. And it started with, I think for us, it started with direct investing. And the LP investing started much later. But that is also now, I think the first investment that IFC made in a fund was probably in the late 90s, much before my time as well. And of course, in the last few years, we've picked up pace and we've picked up the sort of PE portfolio as well. So on the direct side, we're very large lenders. We also cut equity checks, and we are investors in institutions like HDFC. And we were one of the earliest shareholders in HDFC, in ICICI, Bharti Airtel back then when these companies were starting out. So I think for us, direct investing is pretty large. In the direct investing portfolio, debt investing is actually the larger portion of investing for us. On the LP side, on the fund side, I lead the South Asia practice. We've got about 30 odd funds in South Asia, not including some of the sector funds that we have. And the AUM is about $450 million. On an annual basis, we deploy about $100 million or so into funds. On the direct side, it's a much larger portfolio because that includes our debt portfolio as well. And we deploy about close to $2 billion on an annual basis, give or take a few $100 million. So that's largely where we are. In terms of our focus areas, given that we're a development financial institution, all our investments, whether debt, whether equity, direct or LP positions, all of these go hand in hand with commercial returns as well as the developmental impact that we look for. And I think we try to invest where there is, wherever we feel there is a larger need for capital at that point in time. And therefore, our strategy evolves, our opportunity set evolves depending on where we find the opportunity, where we feel the need is greater at that point in time. I'll take a pause now and maybe we'll come back later.
Yeah. Arjun, do you want to tell us about your strategy?
Thank you, Ranjini, for having me. So Verlinvest is a evergreen holding firm of backed by the families behind AB InBev. And really for us, it's a long-term diversification for the family through very relevant investments in what they understand. And that sector is consumer brands. Now, whether it's online, offline, etc., is extremely flexible. But all we do is invest in consumer brands. And so 100% of our portfolio is in one sector. And so we're a specialist to that extent. We are also mainly a direct investment firm. So more than 95% of our assets under management is direct investments. But we do take certain LP positions where it could open up a new area of growth for us, which we don't understand so well. And so an example of this would be, so we were founded in 95, 15 years later in the year 2010, we decided to enter India. Now, having never invested in India before, we decided to take up LP positions to learn the market and to meet portfolio companies of the GPs that we are backing. Now, as we understood that, built up a network, built up a team, and did certain co-investments with those GPs, we got more comfortable to make direct investments. Since then, we've tried to go earlier, and so we backed VC firms to understand the earlier stage of the market. And so that our strategy for taking up LP positions is to learn new areas which we are not specialists at.
Right. Can you talk about some of those learnings that you are now able to incorporate in your direct strategy?
Sure. So I think at least if you take our first foray into India, which was early 2010. We were just scouting for what kind, given our specialty in just consumer brands, we were looking for sizable investments to make, growth equity investments to make. And what we learned over the years, as well as meeting our GPs, is that at that point in time, in the year 2010, it was just too early to deploy the global strategy we had, which was 50 million to 100 million euro checks in growth equity. The market wasn't mature enough. There wasn't enough consumer brands to deploy that kind of capital. And so we decided to go earlier. And so for India especially, which we don't do, let's say in the US or Europe, we could go a lot earlier. So we start writing 10 to 20 million euro checks, and then build up our position to the global average of 50 to 100, but that could take 3, 4, 5 years. And so really the learning was that we are at a much earlier stage in the ecosystem to be able to deploy a one-size-fits-all strategy.
Right. Neha, can you give us a sense of how IFC thinks in terms of which what should be a direct investment and what should be a fund investment, for instance?
So I think for IFC, these two strategies are both very separate from each other, but also go hand in hand at the same time, right? Unlike what Arjun said in terms of how they look at the new market, etc., we're already entrenched in markets like India, and we've been here for over 50 years. We've got a presence of about 200 people in India alone. And I'm not talking about the South Asia offices. So for us, I think we're already deeply entrenched. We have a team of investment professionals. We have a team of sector sort of specialists who work hand in hand and identify opportunities, look for opportunities in these sectors. And again, just to sort of iterate, it's not just from a commercial perspective, but also where do we find the need for capital arising the most, right? So let's say when we look at direct investments, okay, let me give you an example. So out of the $2.5 billion that we'll typically deploy in a year, majority of that is going to be debt financing to mid-market companies, to SMEs across sectors. And this will be across sectors in financial services, in infrastructure, manufacturing, agri, and some of the other services sectors. That will constitute a large portion, almost 80%, roughly 85% of the sort of deployment in a year. What are the sort of opportunities we're looking for? Opportunities which will give us primary opportunities, essentially, where money is going into the companies, helping them expand and grow. I think more and more capital is now being looking to deploy from a developmental angle. There'll be three different things that we look for, right? One is this capital that we are investing into, and this could be for direct as well as for the LP stakes that we take. Is this helping create more access for customers? Let's say access to finance, access to healthcare, access to education, any of those things. Is it leading to job creation? Is it leading to gender diversity or furthering the cause of gender diversity, gender balance within companies, within the ecosystem? Are we helping create new markets for something? For example, when we started, and let me take an example on the fund side, right? In the mid 2000s, when we were looking at the market and we looked at the PE market, there were barely any funds who were existing. A lot of the fund managers were first-time fund managers who were starting out with very limited experience. And that is a time when IFC doubled down in the market and invested a lot. Well, looking back, those fund managers, because of macro, because of other situations, not everybody did very well, and the PE returns from the market in the last 10 years have been limited. But I think our role as a market creator and deepening the PE market was just that. And therefore, for us, in that stage of the PE life cycle or fund life cycle, we didn't want to invest. We were not looking for very great commercial returns.
Right.
Now, when the market has deepened, we are looking for more commercial managers. We're looking at not just developmental impact, but also commercial returns. Also, because you have a pool of very strong managers in the market today.
Right.
And therefore, these are domestic managers that we're talking about, not global fund managers as well. So for us, I think the key criteria is making sure that we are putting in money where the need of the capital is. where need of capital and developmental impact as well.
Right, right. If I can just follow up on that, when you're a development focused investor, and when you're making a direct investment, how do you manage the other investors who may not have DFI goals?
So see, we understand that when we are going into a commercial company, we don't want to dictate their commercial strategy in any way. We just want, for example, and let me give you an example, right? We will ensure that the company is following not just the ENS regulations, right? That it is, but it is going a little bit beyond that. It is looking at the environmental, social, governance risks, and not just looking at it from a loss minimization strategy, but also looking at it from a profit maximization strategy. Because sustainability, we are trying to increase the sustainability of the business in the long term. Gender diversity, for example, there's been research, and IFC actually was part of that research as well, where some 600 odd fund managers were studied across the world, and the research was very clear that gender diverse and gender balanced teams actually earned better returns than their counterparts or than their peers who were not gender balanced, and therefore, and I think people are now understanding that when development financial institutions are insisting upon certain things like these, it is not just increasing costs for them, because of course compliance costs increase. There is a short-term increase in costs of managing all of these things, but in the long term, it is creating a long-term, lasting, sustainable impact on profitability of the businesses.
Okay. Fair enough. Arjun, if I can bring you in, I want to get some sense from you on what are the sectors within consumer that you've managed to understand better over the years and you find it more attractive now.
Sure. Again, we are a bit unique in this because we are so focused and we have certain areas of expertise. So the one that is probably where we have the most experience is food and beverage brands. So anything in FMCG, food and beverage, we have a 25-year track record. We have taken a number of brands global. And so that's something that we are seeing green shoots in India for. It's still very early days. I would say we are 20 or 30 years behind the US, but it's very, very encouraging. And I see it as developing at a rapid pace over the next 10 years. So that's something that we have done in India and we like in India and we will continue to do in India. The other one, which is probably increasing at a more rapid pace, is consumer internet. And this is direct to consumer, whether platforms or brands. So either e-commerce or it could be direct to consumer individual brands who sell their own products. Here again, we are seeing an acceleration with extra fuel given to them by the pandemic. And this is a space which we think will create size very, very fast, probably faster than the normal course of business we were seeing in the last 10 years. And so we're very excited about this. These are the two areas of our focus. Other than this, we have done some education and healthcare investments. But again, we're just in the learning phase. Whereas in these two spaces of consumer internet as well as food and beverage brands, we are 10 years in. And so here we are a lot more comfortable.
Right. Since you mentioned healthcare and education are learning space, do you think you might look at LP investments in, sector-focused LP investments in education and healthcare to kind of expand your portfolio at some point?
Yeah, we could look at that. We are always open to different fund managers who are specialists in what they do. Because again, given we are a boutique specialist, we would like people with mostly operating experience, and that informs and we learn from that experience.
So what are the other sectors that you're looking at then?
So I would say that the next logical step for us to expand our business would be in healthcare. And that's something that we are very interested in. Now, be it online or offline, in today's world, at least my view is it's all merging. And so we would be very interested to understand the healthcare sector a lot more. Right.
Very interesting. I actually want to move on to the performance aspect. Both of you, you have an LP strategy, you have a direct strategy. How has it been? How has your performance been in the last 10 years? If you can give us a flavor, and also a little bit on which strategy has sort of done better. Neha, you mentioned in the beginning that in the beginning when you all were investing in funds, the expectation was more development focused, not so much commercial. But can you give us a deeper insight into how exits have been for you?
So I think this is from an LP perspective, the returns that we generated in our portfolio have been very much in line with the industry returns, right? And if we look at industry returns, um, so if you look at fund managers, there was a batch of fund managers in the late 90s who survived, some survived, some didn't. The next batch of new fund managers came in the mid 2000s, somewhere around the 2005 to 2007 sort of time frame, and that is when majority of the PE investments in India came in. And of course, after that, I think it's just been an uptick of annual sort of investments. If you look at returns, the first batch of funds did very well because there was just so much of opportunity, right? And so little money chasing those opportunities. The 2005 to 2000, maybe I can bucket at 2008, 2009 timeframe fund managers have done okay. But I think there were a lot of constraints that they were fighting against, the macro constraints, the TFC, the currency. But if you look at some fund managers, they've been clear outliers. They've done well in their funds. But when I say they've done well, it's relative. They did well relative to that vintage. And I think returns in this asset class are very vintage driven. And if you look at the post 2009, 2010 fund managers, I think many of them have done very well because one, the market has matured. The market has also been sort of a fertile ground for opportunities. To look for good opportunities, people had more experience, fund managers had more experience, and therefore I think a combination of various factors has helped returns pick up. And we see that across sort of fund managers, across managers. I think one of the learnings for us is that we should try to be present across vintages, unless there's a vintage where there is a clear reason of not participating, right? But otherwise, I think it's quite clear that if you're not, we can't time the market. Like in direct investment strategy, you don't want to be timing the market. You want to be investing in strong fundamental players, companies, or in this case, fund managers, who you believe will be able to manage the timing risk in the market cycles very effectively. And I think that's what we're doing now. So from a returns perspective, I think it's a mixed bag.
Right.
When you ask me what kind of strategies have made money, I think, again, it's a very mixed bag. It's very dependent on the vintage and the kind of fund manager that you've backed. So a fund manager in the mid-market strategy may have done very well. There may be another fund manager who's not done well in the same vintage as well. So it's difficult to generalize. I think it all comes down to the fundamentals of investing, of looking for a strong team who has a good strategy, who is able to sort of pivot the strategy as the market opportunity also evolves, and is not bracketed in a very, very narrow sort of strategy framework. And I think,
please go on.
And this last point, that invest across vintages and across strategies, so that from a portfolio construction approach, you have a very balanced portfolio as well, and it's not skewed towards one or the other.
Yeah. Would that be similar to your direct performance as well?
So direct performance, as I said, is largely debt. And I think the inherent risk of debt investments is a bit lower, and therefore return expectation is also in a certain range. But yes, I would say so. I think we've invested on our direct side. We've invested across sectors, across cycles. And again, there's no clear-cut winner or loser in our mind. I think there are lessons we've learned from every investment that we made, good or bad, and they all sort of get incorporated in our future investments.
Fair enough. Arjun, can I bring you in? Can you take us through what your takeaways are from your decade in investing in India in terms of performance and learning?
Sure, Ranjini, happy to. So we are just about a decade in. So started in 2010 in India, so now just entering the second decade. And really what we have noticed in India versus the Western markets in which we operate in is it takes longer to do a deal in India, longer to manage that portfolio, and longer to exit it.